Very good morning to you all. So we start. Yes. So far, what we have discussed? What are the things that we have discussed? Introduction and then introduction. That's it. You know, it's a lot of that. That login. How is login? Fantastic. Added thing to others. You can give this meeting ID and pass it. Anyone take a photo of this one and then share with your friends so that they can log in via meeting ID by typing the meeting ID as well as passing it. You can comment. And then if you want to have this link also, you can have photo and share it, and they can be. What is his or her name? Linda. Open created is a participant of the anyway, that you can ask the help login session. If not, please tell me and contact the IT personnel. So let's start next lesson. The first question. Do you have investments? Yes. So what sort of sources? Share market, good. What else? Savings account, FDs, unit trust. What else? Lands, it might be in the non-current assets also, yes, right? So if we are trying to move forward with the investment, what are the main factors that we are looking for? Yeah, what are the very simply, what are the benefits, and in identifying this benefit, in gaining this benefit, what sort of uncertainties we have to face, right? That is what we are going to calculate right now in this lesson. But regarding the share, right? Not all the investments, we are identifying what would be the risk and return or the benefit that you can earn, as well as the other one, the uncertainties as well as the risk that you can have to bear from investing in a particular share, right? So this is the lesson called return and risk of the investment, right? Risk and return. Starting from A to Z, that means until the capital asset pricing model also you had to discuss as per the syllabus. So therefore we start first one, calculation of return, and then calculation of the risk, and then based on the historical data as well as future data, how can we calculate the risk and return, and then we move forward with the portfolio performance of portfolios, and lastly capital asset pricing model. A to Z covered by the lesson. Then we all know what is mean by an investment. Investment, current commitment of funds on behalf of what? Or else with the expectation of future benefits for a specific time period. We call it as a one investment. Again, what do you mean by the investment? Current commitment, right? You have to sacrifice the today's fund, right? On behalf of what? Or else with the expectation of what? To have a future benefit. Otherwise, are we going to sacrifice the current funds? No, we might have alternatives. Right? Rather than depositing money in somewhere else, what you can do? You can have a consumption. You can purchase whatever the things you want and then successfully spend your time. Right? So otherwise you don't need to sacrifice money. Why we are sacrificing money? To have a future benefit. Otherwise we are not sacrificing. So that is called as what? Especially it should be for a specific time period, right? Not for less than actually 1 year. Normally we are making the investment for more than 1 year. It might be 2 years, it might be 5 years and all the things. So anyway, there should be a specific time period for this investment. Then what we call as investment is a current commitment of funds with the expectation of future returns for a specific time period. What are the examples then? As you said, it might be investment in share market, investment in FDs, investment in unit trust, investment in land and building. That means non-current assets and all the things. So all are check whether all the examples that I have told, including current commitment or not. If you are going to invest in the share market, what you have to do? You have to sacrifice the current funds. Today you earn 100,000. Part of it is going for the share market. So then remaining 50,000 is only for your consumption or at the risk purpose. Right? So why you can't keep those things with you rather than investing in a share market? Right? So you can have a successful life if you have 100,000 rather than 50,000. So investment means you have to very basically understand by your side, investment is a current commitment. Current commitment definitely with the expectation of return. That is what we are going to identify. If we have to bear a, if we are gaining the return means in return, what you have to have? You have to have a risk. If there are some benefits, there are definitely in identifying, in gaining these benefits, you have to bear a risk, right? So this lesson discuss about risk versus return. How can we calculate if we are going to invest in a particular share? Then current commitment of the fee for a specific time period or a period of time in order to deduct the future payment that will be compensate the investor for. Again, the time of the fund that you have committed and then expected rate of inflation, very important, and then the uncertainties of the future payments. What can you say about this one? The relationship between risk versus return. Yeah, is that positive or is that negative? Risk versus return. How do you perceive about risk versus return? Positive relationship, negative relationship, or the no relationship? Yes. Which kind of a relationship? Yeah, risk. High risk, high return, right? So if we come to the practical illustration regarding share market, preference shares and ordinary shares and bonds. This side risk. This side return. Okay. 5%. 0. So I will give you 3 points. First one. The financial instruments. Treasury bills. First one. Second one. Ordinary shares. Right? Third one. Preference shares. And then the fourth one. Right? So these are the 4 financial instruments. So this is the graphical illustration. You know what this is. Which kind of a financial instrument this is. Can you mark it whether it is A, B, or C, D, or 1, 2, 3, 4? Right? So this side you have the financial instruments. 4 financial instruments. So this is the graphical illustration about risk versus return of those 4 financial instruments. What you need to do is you have to place these 4 financial instruments in these 4 points. Think it and do it. We know risk versus return, obviously negative or positive relationship. Yeah, this side risk. 0 risk, 5%, 10%, 20%. What would be the return? Even there. Think it and try to do it. So we mark it 1, 2, 3. Mark it as ABC. Yeah, discuss with your friends and try to identify. A, B, C, and then D. Yes. Now, what is the first answer? Fortunately, you don't have the MCQs for the paper. First answer. A. Mm. C. D. D. Second one D. Last one B. Any other answers? Yes, exactly. Zero risk. Zero risk, you might have the 5% return for which one? Definitely the government security. So therefore the option should be A or B. That should be A here, B, treasury bills. Then your risk is increasing and then return also increasing. Right? But we compare to these two, bonds are having low risk versus low return for the investors, right? Because they might have some time collected or else they might have some deposit when they are obtaining the loan. So therefore their default risk is lower than the other two securities risk. So then we can mark it as D. That means here bonds. 5 to 10%. 5 to 10% risk and then initial one should be from here. And then what happened? What should be here? Definitely it should be the ordinary share, preference share. Preference share. C. Option C. Preference share. Why the preference shares are having low risk versus low return with compared to ordinary shares? Yes, very good. What is it? Company preference shareholders also having some sort of obligations or having some sort of the legal obligations with the company, because rather than ending of the company, so you know there are some two type of preference shares. What these two type of preference shares? Redeemable versus other one irredeemable. Right? Redeemable means we have a time period. So then once it is come to liquidation, what you have to do is first settle down loans and then settle down preference shares. If something remains, give it only for the shareholders, ordinary shareholders. So their risk is very high. Default risk actually. Default risk is very high. Since they are offering a high risk, since they have a high risk, company have to give the high return. Otherwise, what they are doing? Rather than investing in the company, they will come to treasury bills and treasury bonds, and accordingly they will invest that places. So therefore, to mitigate that one, the company have to give high return than the other three instruments, basic three instruments to the ordinary shares. So therefore, we can place here the option number B, ordinary shares, and here preference shares, bonds, and treasury bills. Right? So by looking at this picture, you can identify which sort of a relationship in between risk versus return, risk and return. Risk and return have which kind of a relationship? Positive relationship. Positive relationship. When the risk is going up, what happens to return? Return also going up. When the risk is going down, definitely return also going down. If you want, you can note it down. So when you are noting down, tell me, you know how to calculate the standard deviation and then the variance via the calculator? Have you learned it? Yeah, no? That means you know it, no? Okay, so all right. No. That means when they are creating the thing, they have not added the students. Is that the case? Also found this. No. What happened was that let's both girls. Let's both girls. Declarated. Let's I hope you guys have this. I tell the event. You remember they have calculated risk and return via the calculator? How many of you bring your calculators for today's lecture? Very good. I don't know what I'm going to do this. Good. Otherwise, we can't do that job. Okay? What happened to Ruksha? Ruksha, no. What's your last? What happened to your calculator? Okay, show it to me. Taki. What happened to your calculator? Yeah, show it to me. Take it out. Patu? Absolutely. For the morning. Full day. You know, Friday is not that much. Normally, when it's come to the other students, so they are feeling that Friday is very relaxed day. Why? They have the weekends now, but when it's come to your end, so you feel so sad at the end of the Friday. So you have to work 7 days. In Sunday evening, and then you have to start work from Monday. Anyway, that's how the journey goes. Most of the commitments give more returns. You are having a high risk, and then immediately after the degree, you have a high return. Right. So then we'll take down the heading return. We'll identify first return. How much of you keep the first page as it is? Draw the mind map. Akiri, Charita and all the others, they are writing those things in the separate paper. So they all have always over time they have a one page, extra page. But those who are writing and booklets, they do not have. Even I told or not, you have to keep the first page as it is with the headings to draw the smile. Lesson, right? So what do you mean? First section we identify the investment. Right? What is mean by the investment? And then we identified the relationship between risk versus return. Then we came to the return calculation. So in calculating, for you to understand this entire picture of this, the first part of this lesson, so we have to calculate risk and return, right? For a which asset? For a share. Which share? Ordinary share. This also for an ordinary share. The thing is, when we are calculating this risk and return, we can use past data and future data. Right? So when we are calculating risk versus return, you can use for the return. You can use historical data. Historical data. Right? And then for the return calculation, you can identify future data. For the forecasted data. Forecasted data. For the risk calculation also same, right? Risk also can be calculated by using the historical data. Historical data. And then for the risk, again we can calculate risk by using the future data, or else we call it as a forecasted data. Forecasted. Historical versus future data. Later on, once after we calculated risk versus return, then we are combining. This is for one share, no? So then combining two shares. It is called as the portfolio. So it's very important to identify the basic concept, right? So you can see here, return and risk for an individual share. That is the first task that we are going to do. And once you identify the first task, or else complete the first task properly, only you can do properly combining two shares. Here one share and then here two shares, not only two shares, combining collectively. Right? So we are doing the investment in two shares. Therefore, having the proper understanding regarding risk versus return for a one share is very important to have the portfolio valuation. Now take down the heading, go to your lecture note and take down the heading, return calculation. Rather than going for the return calculation with the historical data and future data, we just identify how can we calculate the risk and return. The basic way of calculating return. We all know. So this is regarding the share, right? If Shakir invested in a Sampath Bank share for a 1 year period, right? He has purchased this share for 100 rupees. Right? Shakir purchased this share. Shakir. Invested in a Sampath Bank share. Sampath Bank. Right? So 12, and which is 31st. I don't know if it is working there or it's not. 31st December 2025, Shakir invested in a one Sampath Bank share for a rupiah 100. Now, after 6 months, 2026, now Shakir want to sell this share. Right? He can sell this share for 120 rupees right now. Meanwhile, during this period, as an investor, ordinary shareholder, Shakir received 5 rupee dividend. 5 rupee dividend. By looking at this picture, Shakir, you tell me what are the benefits that you have earned by investing in Sampath Bank? Shakir. Exactly, first one is dividend. Okay, good. Dividend. And then, what else? How much is the dividend? 5 rupees. Others. Other than the dividend, what he has earned? Nothing. Yeah, what else he has earned? Yes. Chara. He has invested in Sampath Bank. He purchased it for 100 rupees. Now he's trying to sell it for 120. During this period, he has earned the 5 rupee dividend. What is his total earning or return? Dividend, it's obviously 5 rupee dividend. Right? On behalf of what? Or else on which value he has earned this 5 rupee? Exactly, that is 100. In amounts, that is 5, and then 5 is earned for each one, for 100 rupees. Right? What else he has earned? Is that only the dividend 5 rupee? No, what else? 20 rupees. Why? He has purchased this for 100 rupees. But even he has purchased it for 100 rupees now, he can sell it for 120. Right? That is the amount 20. Right? Amount 20. He has earned this 20 based on which value? Again, it is 100. This 20 rupee earned because of the investment of 100. What is this called? This is called as the capital. Yes, you know it. Capital capital gain. Right? So this is the investment amount, dividend, return, and then another part, capital appreciation or capital gain. D we call dividend, we technically naming it as a D plus. Right? Capital gain, 100 rupee, we name it as P0. P means purchase price, 0 means before the year or else the past. Then PT month, here PT, right? PT means price at the end of the PT or else price in the PT. We don't know which year. So this is how we can calculate the return in relative amounts, right? In the amounts. That's clear. The amount is return is 25. Now converting into the percentage. Always return are not keeping as the relative amounts with the numbers. We have to convert it for a percentage. You have to convert it. Otherwise, you can't see the real picture. In converting this relative amount rupee into the percentage, you have to identify as a base in which sort of amounts. Right? For which sort of amounts, I have earned this one. Definitely, why you have earned the 5 rupee dividend, since you have made the investment for a 100 rupee. And the other one, you have earned 20 rupee capital gain. Why this is? Because I have purchased this one for a 100 rupees. So then, in converting this 25 into the percentage, the base should be what? The base should be the required amount for this particular share. So then you can convert it. P divided by P0 plus PP minus P0, same. Clear? Again, you can rewrite this one. D plus PT minus P0 divided by P0. This is return, R means return in percentage, right? Return in the relative amounts equal return in relative amounts. Dividend equals dividend plus capital gain is a return. In converting this relative amount to the percentage, you can use these two formulas. You can write down this example or the formulas first and then work the simplified example. This is the way how can we calculate the return for a share. Then you can calculate the relative amount as well, or the percentage for the return. Done. Done. So this is what they have explained, even it is PT minus 1 also, that is also correct, rather than mentioning P0 same. I have just mentioned it as P0, that is also okay. How can we calculate the return? Then return equals dividend plus PT minus P0 divided by P. The another way of calculating, right? So this is just for a one share for a 1 year, right? You want market 1 year. For a particular year, how can we calculate the dividend? How can you calculate the dividend? But if you have given more than 1 year, right? If you have given more than 1 year, how can we calculate the return for that particular question? Previously, what you have calculated, again we have calculated Sampath Bank share return for 6 months. But just assume you were given the data from 2020 to 2025 Sampath Bank return. Annual return. How can you calculate the return? Exactly. How can you take in the average return? Right? You have to calculate the return by using average return. The way of calculating average return, you were given the calculated return for several years by using this formula. In the sense, if you want to identify the return for 5 years, average return, take the total return and then divide it by number of years. That is the way of calculating average return for a Sampath Bank if you have given more than 1 year data. So then how can we calculate? Take the return for the first year, take the return for the second year, R means always return. Return for the first year, return for the second year, return for the third year. Until the nth year, take the return and then divide it by n. That will give us the which return? Average return R bar. The other way of writing it like this. R bar. R bar. Total return. Total return. You want again total return divided by number of years. You can do the question number 7. Question number 1. Right? You were given the return data and then what you have been asked, calculate arithmetic average rate of return. That means R. Calculate R. R equals arithmetic which return? Average return. That means R bar. 5.3 plus 15.6 bar minus 7.3 plus 15 plus 19.8 divided by how many years? 1, 2, 3, 4, 5 years. 5. The answer 7 point or 9.68. The answer average return 9.68. We have 5 years data. Take the total, divide it by number of years. Here it should be minus because why? Minus return was there. Now take down the heading, risk calculation. Risk. Risk calculation. Why do we want to have a risk? So within today, how many risks that you have faced? Yeah, you hope you might take up for 5:30. No, 5:30. Good. From 5:30 to now it's 9:30. For 9:30, how many risks that you have faced? What is the first risk that you have faced? Alarm. You keep the alarm for 5:30. If you want to wake up for 5:30, what's the alarm time? Exactly. 4:15 onwards. 4:15 onwards, you are keeping the alarm, right? Even you can't get up at the 5:30. What's the first is? You expected to have it for a or else wake up for a 5:30, but you are unable to do that duty on 5:30. What is your expectation? 5:30. If you wake up for a 6, what happened? That's a risk. Why? You can't come to the lecture properly. First. And then second risk. What is second risk? Second risk. If you are trying to catch up the bus, if you are trying to make the time on the to the way to home to the Sam, sometimes there might be traffic and all the things. You want to come at 8, but you are unable to come at 8 and you reported 8:25. Right? So what's there? Risk. You want to report at 8, but you were reported at 8:25. Your expectation is 8, but the actual is something different. Now you have a risk. Why? Lecturer will blame to me. Don't you? No, you are very, when you are coming to the lectures, if you are late, you have some sort of feelings, no? Then I'm also late. That's right. Yes, anyway, you might have. That's what. That's the risk you have. And then later on, now the expectation of to have your break for 9:30. But after 9:30, your heartbeats will full whether the lecturer will give us a break or not. What's it? Again, risk. Even you might have some hungries, you don't have your morning refreshment and all the things. Again, what you have? You have the risk. 3 risks, normal risk. Basing these 3 risks, explain why, what, or else, what sort of scenarios you are having a risk. What sort of scenarios? Even you expect the actual, even you want to have something, or else as per the guidelines, so you have expectation, but the actual is something different. 5:30 but 6. 8 but 8:30. 9:30 but 10. You have the expected level and then you have the actual level. Expected is 5:30 but the actual is 6. Expected is 8 but the actual is 8:25. Expected is 9:30 and then actual is 10. All these 30 minutes, in this 30 minutes, you have what? You have a risk. So then what is mean by the risk? Risk is again created on which one? Based on the return. Now we'll come to our side. So you want to have 10 million, but you won't have the, you might not have the 10 million. You have earned less than 10 million. That might be 5 million. Your expectation is 10, but the actual is 5. You have a now risk. Now we'll go to the percentage ones. This year by investing, this year Shakir want to invest the Sampath Bank share and his expected return is 5%. But unfortunately, by calculating the return for that, as we did here, by calculating the return for the particular Sampath Bank share, that is 2.5. The expectation is how much? 5%, but the actual return is how much? That is 2.5. Is there a what? There is what? Expectation is 5, right? 2025, but the actual 2025 actual was 2.5. In between 5 and 25, there is a difference, right? There is a difference. How much is it again? 2.5 difference. Or we can call this difference as one variation. Variation of what? Variation of this is return. This is return. So then variation of return. If there are variations of return, definitely what you would face? You would face the Let's then we can call the risk means what? Risk means the volatility of return. This is for just 1 year, right? But just imagine for 5 years, for 10 years, what happened? You might have volatilities, right? Variations or volatilities of which one? Of the return is creating what? The risk for the investors. Clear? You can, if you want, you can take down. Then what do you mean by risk? Volatility of the return. You might see this one. So this is the actual figure of the investment in Sampath Bank for 2024, October 2019, sorry, 2024, September 19. If you are just concerned about the prices, right? Prices. What happened to these prices? Change, right? 19 to 77, 78, 78, 77, 75, 74, 72, 72.2. What happened to the prices? Price changing. Just imagine you have acquired this for 78. Calculate day by day return as we did. What happened to your returns? Return is changing. First day return is something else. How can we calculate? Now I'm going deep. 79 minus 78 divided by 78. Right? So what is your return? For the October 1st. September 30th, how much is it? 77.5 minus 78 divided by 78. Second day, return. Right? Third day return, September 27. 78 minus 78 divided by 78. 0. And then here, 78.5 minus 78 divided by 78. You might have differences. Last one. 72. See here, 72. Final that 78. 78 divided by 78. So what happened? This is without dividend, right? For the day ones. You have invested for 78. You can look at here the way of your return has been changed during 10 days. So this creates what? This is a risk. Even you have expected at 78, always it keep at 78 as in the September 27th. You do not have risk, but that's not actual. Based on the market conditions, right? Now what happened? Third World War coming soon. Might be or not might be. What happened to the gold prices? It's trying to changing, right? It might change in future. What happened then? Definitely no poor stock market, even for the first attack also, the stock market prices also going down. What happened? Going up, going down. This is creating a huge impact on the investors first into the return. Changing return means definitely we have a risk. That's a normal case, so you can also understand that one, right? Price එක වෙනස් වුණා කියලා කියන්නේ risk එක. That is mean by the risk. Then we can go to the dividend calculation, right? Just imagine 2025 dividend is 9.35. But have been started from 2019. Even see the dividend also always changing, not the same. Right? Dividend changing means what happened to the return? Look at here. What happened to the return? It's changing. Selling price changing means dividends changing. Selling price changing means what? Return change. Right? So this is called as what? Changing always return as not expected, or else if you are not meeting the expected return, or else if your actual return is not similar with the expected return, that's the way of the scenario risk is created for an ordination. Clear? Return එක වෙනස් වෙන තැන තමයි අපිට risk එකක් ඇති වෙන්නේ. So then risk is what? Risk is the variability of return from those that are expected. If you buy a common share for a one company and hold it for a 1 year, the cash dividend that you may anticipated receiving may or may not material as expected, the first one, and then at the end of the price, stock price might be lower than the expected, may even have the less than one you have started with. That's the second case that we have already identified. Thus, your actual return on this investment may differ, right? May differ with the substantially from your expected return, where it is called the risk, right? Where it is called the risk. Actual return substantially different with the expected return or the variability of return that are expected called as the risk. If it is a variation, to capture this risk, what sort of statistical method we have to use? Variation is measured by which calculation? Variance, right? Then identification of risk have to calculate it with using what? Standard deviation and then the variance, right? Variance, how can we calculate? Average versus, you can compare average versus actual and have the variance. Based on that variance, you can apply the standard deviation. Write it there. Standard deviation is the measurement for the risk. Always, if there is a question to calculate the risk, means you have to ultimately calculate what? Standard deviation, right? Okay. Coefficient of variation, that is the investment decision point. So then we'll take it down. How can we come up with this calculation? Right. Now we'll. So the historical data, return historical data, how can we calculate? This is average return. Way of calculating average return, total return divided by number of years. Then now we add the historical data calculation. With the historical data, calculating the risk. With the historical data, calculating the risk. The way of calculating the risk. That is which. How can we calculate? First, you have to calculate the weight. And then you have to calculate the SD, standard deviation. The way of calculating the variance. How can we calculate the variance and how can we calculate the standard deviation? We know standard deviation means what? Square root of the variance. Square root of the variance is the standard deviation. The question is how can we calculate the variance? Did you remember the way of calculating variance? Yes? You remember? Good. You tell me the way of calculating the variance. What is, so I'm writing this formula with the order of the variance calculation. Let's look at it. First, you have to calculate one R bar. R bar. R bar means what? Look at here. All these are linked. R bar means historical return. Average return. After you calculated R bar, that is average return also, then you have to consider what? Here you have mentioned the I. I means what? Always below this notation we marked it. That is the way of measure. That is the way of indicating that particular share name. So this is which share? Average return of I share. Right now. Then you have to consider what? Actual return of I. Right? RI means actual return. RI. Actual return. You can write these formulas in the given space and then come to your mind map. Right? Now you have calculated R minus R bar. You have taken the differences. Right? You know there might be some, when you are taking the differences, there might be some positive and negative differences. If you want to take the variance, proper variance, if we are adding this minus and plus variances, minus and plus figures to minus to plus, what happened to that? Those will be set off. So then to avoid that one, we have another technique. What is that? Taking the scatter balances. We have to scan that balances. We have to scan these differences. Right? Don't worry, we'll do those things. Then you have to take the total of scatter balances. And that should be divided by N minus 1. Right? So this is the way of calculating the variance, and then square root of variance is the standard deviation. Just to explain the way of calculating it. This is the first step. First step. Second one. Third one. Take the total. Fourth one. Divided by N minus 1, 2, 3, 4, and fifth one. Right? Don't worry, we'll do the question and then it will be very clear to you what. You can use your highlighters and highlight those things. Even you multiply that answer by 1 or N minus 1, that is also correct. Or else if you minus it, if you divide it in minus 1, that is also correct. Right? 1 over N minus 1, or else divide the entire answer by N minus 1, that is also correct. Okay? Try to the answers. Calculate the answers now. Now look at here. You were given the calculated return for the two shares for 4 years. You have historical data. Is this historical? Tell me first. Is this historical or not? Is the given data historical or not? Historical. Why? We are at 2026. But you were given the data for 2020 to 24. right? Then you have to calculate what? Average return, variance, standard deviation, and then the coefficient of variation. That is later on we'll do it. What is the first step? Average return. Calculate the average return for these two stocks first. And try to do this one. You discuss with your friends and then try to do it first and then understand the question by your end. Try to do it. One by one, or else year per year, you have to calculate the not the variance, the differences. R minus R bar to the power 2, or the scalar balance should be taken for 4 years. And after that one, you have to take the summation. Because when you are calculating the risk, you are not calculating the risk for 2020. You are calculating the risk for entire 4 years or 5 years. Average return also 5 years. Average return is how much? Very good. 10.9 and then 9.2. Yeah. Did you remember the way of calculating it? You have to change the mode first. 10.9 and 10.9, 9.2. Have you all got the same answer? Average return? No. Shakir can come to this one, this side. With other ball, Lakshya. Lakshita, no? Average return. How can we write down? Statistically, how to write it down? Average means R bar. Then R bar for which asset? Asset means or share. Sometimes I will call it as asset or share, right? R for which asset? For which share? For S. Average return R bar for which asset? C. How can we calculate? Take the total. 10.5 plus 12 plus 13 plus 9 plus 10. Altogether, how much? Tell me the total there. 100. I forgot to bring my calculator. That's it. 54.5. Divided by how many years? 1, 2, 3, 4, 5. Total return for 5 years is 54.5. So then average return, that is 10 point. Sorry, 10.9. Good. Then we'll move towards the C. Share C, stock C, 8, 12, 7, 13, 6. 9, 20, 20, 40, 46. 46 divided by how many years? 5 years. The answer 9.2. First class done. Even we might receive the 10.5 to 10 or 8.8 to 6. Average return was 10.9 and then the other one 9.2. Done. Now the thing is calculating what? Calculating the differences. Calculating the differences. What you have expected? 9.2 and then the other one. So 9.2 and the other one 10.9. But you will receive different answers. 2020 you will receive 10.9. But your expectation is how much? 10.2. 12. But your expectation is 10.2. Here 10.2. You have to take what? First take the differences. Right? We'll do it. Then take down these 3 columns. Year, annual rate of return for stock C and for stock S. Then we'll go to the next column. Identification of differences. Right? Differences means you were given, this is what? This is RS, return for S. This is RC, return for C. These are actual returns. But the expected return was, that was 10.9. 10.9 always. Here 10.9. Here 9.2. First year of 2020, I expected 10.2, sorry, 10.9. But received 10.5. What's the difference? Minus 0.4 or else minus 40 cents. 2021, I expected 10.9 but received more than expected 12. I have a positive return there 1.1. 2023, I just expected 10.9, received more than 10.9, that was 13. And that was 13. What was the difference? Surplus 2.1. 2023, I just expected 10.9. Unfortunately, I just received 9. My relative return was decreased by the 1.9. Last year, 2024, I just expected 10.9. Unfortunately, I just received 10. That is again my surplus decreased by minus 9, 0.9. That's regarding the share S. Now being identified, the references for the C. The references for the C. You all can calculate it. I just expected 9.2. Unfortunately, if I invested in C, I have received 8. The difference was minus 1.2. I expected only the 9.2 for the 2021, but I have received 12.9. That is the surplus 2.8. 2022 received 7, but expected 9.2, 2.2. 2023 expected 9.2, but received more than it, that is 3.8. 2024 received only 6, but my expectation was to have 9.2, that is minus 3.2. Minus 3.2. So these are the differences. These are the differences. 3.2. These are the differences. Look at here. If you take this differences, right, and then moving towards the calculation of variance, can you have a real picture? No. Plus to minus, plus to minus, minus to minus. What happened? There might be some numerical errors. To avoid that one, if you remember, right, this is what we have did. Ri minus R bar I. To avoid that, mathematical calculation issues, you need to convert these to the scared, right? You have to convert these balances to the scared balances. Apply the same one to the same differences. Apply the scared balance. Only the difference was convert those balances with the scared balances. Now do it. If you are typing the minus figures, type the minus figures within the brackets. Otherwise, you might get wrong answers. Answer 145. You can come and sit at the front doors, right? Please here from here. Now you are on the path, so then you can do the various population and standard deviation calculation.
What is it? And did you remember that? Come on.
Population variance sample variance the population variance sample variance ඒක තමයි ඔය අවසාන දෙකක් දෙකද තුනද කියන්නේ. එතකොට ඒකෙන් මම හිතන්නේ වෙනස්.
ඒක අර අපිට කරන ප්‍රශ්නේ සිග්මා එක ගන්න.
You can check whether your answer is correct or wrong by using the calculator. So motivation. This is the first time for the lecture. What happened here, friend? The other girl? Okay. But color where you want. Yeah. When you are asking the question from the others, you have to also be there. They can't explain. Sometimes what you can do is you can learn and explain those things as a presentation. Sometimes if you want to have a further explanation regarding the estimate share market, you contact a person from the share market and then arrange an interview. And then after you are one, you can have a short video clip, you ask a question and they will explain that one. Then you do your part and like that. If anyone want to conduct the valuation of the bonds, the financial instrument, we call the Security Exchange Commission. You have been assigned the financial institute. SEC, you contact a person from the SEC and then Rakshit will interview that person and have the discussion with Rakshit is asking question, he is explaining. Like a small video technique, by combining all things, you can have a video. That's the way of that's your creative, other than just doing presentations. Yeah, you also can do. Sometimes you also can have both regarding the Colombo Stock Exchange. You both can explain those things. As you go to the restaurant, you are discussing those things. Now you know the Colombo Stock Exchange. Yeah, you know this one. So this is Colombo Stock Exchange. You cannot do you have an investment there. So one of the things, so then she can explain and likewise that conversation also going through that. So then the other one can record it. We put that one to good presentation. Presentation we have here. That's your creative. Not way rather than the just presentation. You have to identify the skill. The creative method of creating the presentation. Presentation also okay. What do you mean by position of variation? You know that one. This divided by return. What is this? What does that mean? This divided by return means what? For a one return, how much of this that you are going to bear? Variance. If I ask a question like this, we just discuss that point and have a break. So if I ask a question, what sort of investment that you are going to select? What sort of a share that you are going to select for investment? What should be answer? Is that C or is that S? S. Why that is? Why? Why? Standard deviation is, or the risk is 1.5, but the return is 10.9. But we compare the standard deviation and risk of the C, 9.2, but return also is also high. But doing like that, even the scenario is like this, so this particular one, but always not you are receiving not the same answer. You have to rationally explain it. How can we rationally explain this? You as a rational investor, you have to identify how much of risk that you have to bear for a one particular return where we are calling it as a coefficient of variation. You have to calculate coefficient of variation. Next one, write it down. Coefficient of variation. Coefficient of variation. Equals. Coefficient of variation equals. Coefficient of variation equals risk divided by return. Risk divided by return. Then you calculate coefficient of variation for S and coefficient of variation for C by using your figures. First one, S. You divide it by 1.5 by 10.2, 10.9. What is the answer? 0.141464. Second one, that means C. You have to divide 3.11 by 9.2. 9.2. The answer is 0.33. Better the meaning of right? Now look at the coefficient of variation. Which one is high and which one is low? C is high, S is low. If S is low, what is that reflect? Yes, we'll interpret the answers. For the C, what is the answer? How the interpretation goes? For a one particular share, right? One particular share, that means that is C. For a one return from C, investor have to bear 0.338 risk. Right, again, from C, one return, investor have to bear 0.338 risk. One return from C, one return from C have to bear the risk of 3.338. Regarding the S, now look, full stop and S. Tell me the S interpretation then. Write down by your own. One return, to earn one return, investor only have to bear 0.146. To earn one return, investor have to bear only 0.146. Now, which one is beneficial? S or C? That is S. Why? C have to earn one return, you have to have a 0.338. Whereas S gives us only for a one return, you just bear a 0.146. Write it down. Third one. Accordingly, rational investor should select investment in S since coefficient of variation is low with compared to stock C. You can have your break. You can have your break and come.
Thank you.
32. But we are discussing here is the future return and raise based on the future returns. So we can calculate the risk versus return. Again, risk versus return based on the forecasted data. Forecasted data. In identifying forecasted data, right, the economic conditions needed to be considered. In identifying the economic condition, the probability of this economic condition is very much important. So there are three different economic conditions. The probabilities of occurring those three different economic conditions given here. This can be done by the financial analysis. What might be the future economic conditions and what might be the probabilities of the future economic conditions. In particular scenario, there are three. That means good economic condition might be there, and then normal as usual, and then bad economic condition might be there. If it is normal economic condition, the probability of occurring the normal economic condition is 50, and then there might be a chance, 30% of chance to occur a good economic condition, and then there might be a chance for 20%, there might be a bad economic condition. So forecasted means you have to identify the future returns under different conditions. You can't say that all the returns might be occurring at the normal economic condition. Can you say like that? Can you say like that? Can you predict, okay, within next 5 years or next 3 months, next 1 month, the future economic condition might be normal. Can you predict it? Can you predict it? Normal economic condition is the economic condition for the next 5 months? No, you can't, because there might be different economic condition. Even today evening also might be changed. Even after lecture also economic condition might be changed. Can't it be happen? Okay. And so then how can we take into the consideration three different economic condition or whatever the economic condition as per the financial analysis, and very important, you have to consider what? Probability of that economic condition. Under the different probabilities, you have to identify them. You means the financial analysis will identify future returns. So if the normal economic condition happens with the probability of 50%, ACL will give us 10% and then the JKH will give us 15%. But if the economic condition good with the 30% of chance of being occurred, ACL generate 15, whereas JKH generate the 20%. But if the economic condition is bad, what happens? ACA generate only 8.8%. Whereas sometimes there might be the rating again 15, even the economic condition change from normal to bad. JKH return doesn't change. It might be same. This has been done by the financial analysis. Now, if the condition is like that, by looking at this picture, how can we identify the return versus risk is discussed this section. Clear? Are you clear on this? If we are looking at this picture, how can we identify the risk versus return of our investment or the particular stock is going to be discussed in this section. That's why I have given there, right? Calculating risk using which data? Forecasted data. Calculating risk, calculating here return with the forecasted data. Calculating risk with the forecasted data. We have to change the method in these two different cases. Clear? If you want, you can draw this one. Take down the heading, future return and future risk. Or forecasted return and forecasted risk. And you can write this. Where to 3 you have which subject? MIS. Tomorrow morning you have financial reporting. Okay, now looking at this one, can you tell me how can we identify the expected return for the SEL and JKH? Just thinking, how many stocks do we have? We have 2 stocks. If we are investing in these 2 stocks, definitely you have to bear these 3 economic conditions. We don't know what might be. Right? What might be, we can't predict it. But you have given the probabilities. Right? Either you have to select JKH or the ACL. Both are having this type of economic conditions with the probability. How can we identify the forecasted return now? Forecasted return. Yeah, can anyone tell me? කොහොමද මේක බලන්නේ? Yes. What do we actually consider? Can you take 15, 10, 8, hold what we did previously? Tell me. Forget about these economic conditions. New thing is economic condition and probabilities, right? Rather than giving the years, what you have given right now, years, and rather than giving the years, you have given the economic conditions and the probability. Right? And now if it is years, what you are doing is 15 plus 10, 25, 20 plus 25 plus 8 means 33 divided by 3. That is 11. That is your average return for the ACL. Now can you take like that? Previously, in calculating average return, what you have identified the given return and then the number of years. Return also given here, but the number of years is not given. Then how can we identify? What do we need to consider? Rather than years, what do we need to consider now? You all are looking at that one. But your mouth are not opening to read that one. But if you are looking at now, the probability is not part of the probabilities. Right? Then how can we consider the probabilities? By considering the probabilities of the different economic conditions, you have to identify the which one? Forecasted return. Then forecasted return equals how many economic conditions do we have? 3 economic conditions. If you are investing in ACL, definitely you don't know what might be there. We don't know it. So then what you have to do is, if the economic condition is good, am I receiving 15% of return or am I receiving 30 multiplied by 15% of return? Yes, exactly. You are not receiving entire return. Return will take the economic condition X. First one, return under the economic condition X multiplied by probability of economic condition X. Right? Then, is that all? No. If you are going with ACL, again you have to bear the normal economic condition as well. We don't know. No. Economic condition normal, we take it as what? Return under the economic condition Y and then probability of economic condition 1. Is that all? No, you have another one. If you are going with ACL, have to bear the bad economic condition as well. This is how can we calculate average. We take is return under the economic condition set multiplied by probability of economic condition. Individual calculated. Now you have to consider what average means 4, right? Then add all these, right? And all these. You can rewrite this one. How can we rewrite? Rewrite formula is given there. Total probabilities multiplied by the number different assets. We could calculate return for ACL and JKH under the 2 different scenarios. 3 different scenarios. 3 different scenarios. Calculate the JKH and ACL. Write down formula and then quickly apply it here. You can take down heading notes, expected return, and then write down formula. If you want, the next note given there, the hand. Basic formula is expected return. Sorry, I have to mention mark it here. I become expected return. Always future means expected return. Sorry. Expected return. This is probability. This is probability of economic condition. It's given there for you to understand economic condition X. Right. So this is mean by return. Return for stock I. Stock I under economic condition. Economic condition. Economic conditions. Again with them, right? So this is made by the probability of economic condition X. This means return for the stock I, return for the stock I under the economic condition X. Can't take only the economic condition, only one, you have to take one. As we will take the total, right? Take the total. That's why I have here there, put the mark. Total. Total is denoted by sigma. Total is denoted by sigma. Don't worry about these formulas because definitely you get the idea once we are doing the formula. We are formulas in the questions. Okay. So what is the answer? Yeah, this is the answer for this one. Take it. Head point. How did you calculate that one? First one, 0.3 multiplied by 0.2. And then 0.5 multiplied by 0.15. Then 0.2 multiplied by 0.15. The answer is 0.165. Is that 0.65 or is that 0.0165? What? Otherwise, just multiply 0.3 to 20 and 0.3, 20. 0.5, 50. 0.2, 50. Again, you can calculate your combinations, the same 0.5 answer. Okay? You multiply 0.16. Yeah, 0.165. That is okay? That's okay. That's absolutely. Yeah. Dalit. 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 Open brackets, 0.3 multiplied by 20. Also that 0.5 multiplied by 1. If you take both decimals, you have to multiply it by again 100. Tell me. JTH done. ACL is R. ACL is 0.11 or else 11.1, right? 11.1. How can we calculate Sumadhu? Tell me the way of calculating. It can be 0.3 multiplied by 0.15 good, and then plus 0.5 multiplied by okay, the answer 0.11, right? Lakshit. Okay. Okay. Done. Okay, right. Okay, so then we'll wind up the first session. Tomorrow morning also you have this. Tomorrow morning? No. Financial reporting. Yes. What is it? Is it working? Working? This is limited 3 to 6, but we are in after 3 to 6, okay? So therefore I will listen. Okay, you can leave the 5 seconds. I will leave. Okay, online participants. Okay, Marshall, I will mark attendance after 3 to 6. In the 3 to 6 lecture, right? So I was unable to share the screen. So then I will mark attendance in the lecture 3 to 6. Okay. Can you hear me? Can you respond? Is that okay with you? It's okay with you. So then we'll wind up. Thank you very much for participation.
Happy to see you.